Thank you, Marcia, for that lovely introduction. And I also want to say good morning to all the attendees. By way of introduction, bios for Tram and I are included in the back of the slide deck. I'm not sure you'd be interested in a deeper dive to our credentials, but it does have our contact information included there. Tram and I are very pleased to be able to support on behalf of Aprio, the Chamber of Commerce and the VIP program. It's literally, as I've said before, a privilege and an honor for us to provide this kind of service to veteran business owners. And in this case, we're particularly pleased that you've joined us today to learn about one of our favorite topics, cost reimbursement contracts. In the services industry, at least, many contractors get their start with time and material or labor hour contracts, frequently on level of effort or staff augmentation basis. These contracts have basically three variables: labor categories, labor rates, and hours, and therefore they can be relatively easy to manage from a cost sort of budgeting standpoint. However, the nature of the federal market is such that many of the largest and most important contracts are awarded on a cost reimbursement basis. So the bottom line is that for a government, certainly services contractor, I would say in general for government contractors, they must be able to win and perform cost reimbursement contracts in order to reach their full potential and to maximize their growth. Aprio's decades of experience supporting cost reimbursement contractors allows us to make the following two observations, or as we like to call them, truisms. Please flip the slide. Truism number one: cost reimbursement contracts are substantially more challenging to manage than their fixed price or T&M counterparts. Can you flip the slide, please? Truism number two: many government contractors are unaware of truism number one. Can you flip the slide, please? Hopefully that resulted in a chuckle or two, but this lack of awareness is no laughing matter because a poorly managed cost reimbursement contract can result in incurring a loss. You may say, the government has promised to reimburse all my costs. How could I possibly incur a loss? Well, it's challenging and you have to work at it, but it can be done. Of course, it's much more likely that poor cost management practices will reduce the profit that you otherwise could have made. Poor cash flow can result for two reasons. Failure to invoice all of the costs that you were entitled to invoice hurts your cash flow, if not ultimately your bottom line. More often, you submit an invoice in the wrong format with incomplete information, or that includes a cost that does not qualify for reimbursement. Your payments can and will be delayed for these and many other reasons. Accurate cost reporting, I should say, and projecting is integral to the success of most cost type contracts. The project management team and the COR, contracting officer's representative, depend on accurate cumulative cost data and information, frequently sliced and diced by contract line items, by work breakdown structure, by time periods, and by cost element. Accurate cost projections are equally important. The capabilities of the accounting system that supported your fixed labor rate contracts may not be sufficient for managing cost reimbursement type contracts. Poor cost control, and unfortunately I've seen this, can cause an otherwise technically well-performed contract to fail. And lastly, inadequate accounting systems. Contractors must have an adequate accounting system to perform cost type contracts. If the government determines that your accounting system is not adequate, you will, among other problems, be ineligible to win any more cost contracts until such time as your accounting system has been fixed and reapproved. And as a subtle but very real corollary to finding your accounting system has been disapproved, if you will, is that companies in that situation end up spending a great deal of time in the back office working remedial measures. And if you compare that to a firm that has 100% of their best and brightest people working on winning contracts and performing them profitably, as opposed to fixing back office problems, well, you can guess which company is more likely to succeed in the marketplace. And last, but certainly not least, submitting a cost type invoice to the government is a highly regulated activity that, if done improperly, may result in violations of the Civil False Claims Act, and in egregious cases can even have criminal violations. In a nutshell, a false claim consists of submitting a request to the government for a payment that you are not legally entitled to. So there are many reasons to approach cost reimbursement contracting carefully, with one eye on the statement of work and one eye on your accounting, timekeeping, and billing systems. The objective of our training today is to provide y'all with the knowledge and guidance that you need to help ensure that your experience with cost reimbursement contracting is a pleasant one. Let me flip slides. Now we'll go over the agenda here. We'll start with a quick introduction to cost reimbursement contracts that contains just some very basic information. This section will probably be most valuable to the less experienced attendees here. In the next section, we'll attempt to answer perhaps the most important and complex question: what costs can be reimbursed under a cost-type contract? Some of my friends outside of government contracting, and unfortunately some politicians, think that cost reimbursement contracts are some foolish government idea, that the government is just writing a blank check and that the contractors wastefully get paid whatever they spend and are laughing all the way to the bank. In fact, some contractors may look at the dictionary definition of cost, quote, the amount of money spent in producing or doing something, and say, I spend the money, the government reimburses the money, how difficult can it be? Well, not only can it be, it is difficult, because the definition of cost, when the word is used in the phrase cost reimbursement contracting, is much more nuanced and multifaceted than the dictionary definition. Once we have an understanding of what costs are in the context of cost reimbursement contracting, Tram will take over and discuss the process of how you actually invoice your cost, and then more specifically, discuss some issues related to both direct cost reimbursement and the reimbursement of indirect costs. When Tram is through, we will throw it back to me to go over some practical tips for managing cost-type contracts that we have gained from both our experience in industry as well as working with clients here at Aprio. Flip the slide, please. All right, there are 5 types of cost reimbursement contracts differentiated by the method of earning a profit or lack thereof. There's a cost-sharing contract. As the name implies, the contractor must contribute some of their own funds to the job rather than making any profit. Cost-sharing contracts are not common. They're more common in the grant world, I'll point out, but I have seen them. There are also cost reimbursement contracts where the government will reimburse your costs, but you will make no profit. I've not really seen many standalone contracts like that because there's no real incentive for the contractor to play. There are, however, CLINs in contracts, such as in a time material contract, the material is cost reimbursement, no profit. I've seen CLINs such as we don't pay profit on travel and ODCs. That's in this CLIN. So a contract may have cost-only CLINs. The last 3 types here are much more prevalent because you can earn profit on them. The profit in a cost-plus incentive fee contract is the function of an algebraic formula that takes into account your cost experiences and occasionally technical and schedule achievements. The cost plus award fee contracts are similar to cost plus incentive fee, but instead of a formula, the earned profit is based on more of a subjective report card type of evaluation of the contractor's performance. Cost plus fixed fee contracts, as the name implies, the fee or your profit is fixed at the start and is not subject to the adjustment based on contractor's performance. For the most part, the remainder of this webinar will not address the various types of profit. Our focus will be on managing the contract from a cost control perspective and the information provided will be equally applicable to any of the cost-type contracts. Aprio cannot help contractors maximize their profits through superior technical performance, but can unequivocally state that profits will not be maximized without superior cost control. You can flip the slide, please. All right, so the next thing that we wanted to talk about is when are cost type contracts appropriate? Per the FAR, a cost type contract should be awarded if the requirements cannot be precisely specified or there are performance uncertainties that cannot be accurately estimated. Many government, especially their IT projects, have an objective to meet and a general idea of what it's probably going to cost. But there are too many moving parts over too long a period of time to negotiate a fair and reasonable fixed price. Here's an example of where performance uncertainties affect the contract type decision. A requirement to install, say, a dozen prefab modular trailers with electricity, plumbing, and communications in my hometown of Titusville, Florida, would probably be awarded on a fixed price basis. That same contract to be awarded in a war zone, which sadly I would have several examples I could refer to now, you'd probably see the uncertainties there such that that should be a cost reimbursement award. All right, flip the slide, please. All right, so the next thing on the agenda, and probably the most important thing I'm going to talk about, is what are costs, okay? So we thought the first thing that you need to understand to successfully manage a cost reimbursement contract is what is a cost. The word cost, or a variation thereof, is used in the FAR almost 37,000 times. That includes the department regulations, I should point out. That's a clue. It's an important word. Yet, the word cost is never defined in the FAR concisely in one place. This is because a cost on a government contract is a complicated, almost ephemeral concept, one not easily reduced to a succinct definition. And it also should be noted that the meaning of the word cost as used in the FAR probably needs to be complex to protect the taxpayer whose money is being spent. And it should be noted that in the FAR's working to try to define what costs can be reimbursed, they're going to err on the side of protecting the taxpayer, not err on the side of protecting the contractor. So for the purpose of this presentation, we're going to define costs first by reviewing some very general definitions and requirements that will introduce several key words and phrases. We will then drill down and define each one of these keywords and phrases, which collectively will give us an understanding of the word cost means in the context of cost reimbursement contracting. And so we'll start here on the slide. As you can see by the FAR definition, cost reimbursement contracts allow for the payment of allowable, incurred cost to the extent prescribed in the contract. So right off the bat, from this definition of a cost reimbursement contract, you see three very important terms that you need to understand before you begin to perform cost reimbursement work. The words are allowable, which I will discuss shortly, incurred, which will come up more in Tram's presentation, and to the extent prescribed in the contract, which I will also discuss. Change the slides, please. Thanks. Here's two more things we need to understand to help figure out what are costs. In fact, this slide is a quote from the allowable cost and payment clause, which is 52216-7, one of Aprio's favorite clauses. To use the FAR language from the previous slide, this is a term prescribed in the contract, and that clause will be in every cost type contract. Excuse me, the allowable cost and payment clause addresses a variety of subjects, some of which Tram will discuss later. But for this purpose, it states that the government will make payments to contractors in the amounts that are determined to be allowable by the contracting officer in accordance with FAR Part 31.2 and the terms of the contract. Okay, so that's yet more words. Now, first, there's the word allowable again. So that's the second time that's been used. And secondly, even one of the terms prescribed in the contract goes out of the way to mention that there may be other terms prescribed in the contract that affect the reimbursement of costs. So again, this is the second time that that's been mentioned, and it means it is very important to read your contract. And I don't know how many times we get a prospect call or we're talking with a potential client, they're explaining their whole tale of woe, and we'll simply say, well, what's the contract say about that? Or have you read your contract? Or does the contract include this? And it turns out that it never occurred to them to read the contract, oddly enough. All right, so in addition to the terms in the contract and the word allowable, this allowable cost and payment clause introduces two new terms. The first is to be determined allowable by the contracting officer. It is essential in cost reimbursable contracting that you build a relationship with the contracting officer. The contracting officer's representative, or the core, is not and never will be authorized to determine what costs may or may not be reimbursed, even though sometimes they think they are. Many of the problems contractors encounter on cost reimbursement contracts are caused by a strong, aggressive COR working with a weak or uninvolved contracting officer. Sometimes after a client describes a contract issue, I'll ask, well, what does your contracting officer say about it? And they'll say, I don't know. I didn't think to ask her. Worse yet, some clients aren't sure who the contracting officer is. So I don't mean to imply this is an example of the old adage, keep your friends close and your enemies closer. But a close relationship with a strong contracting officer is almost always a hallmark of a successful cost type contract. The second new concept that the allowable cost and payment clause introduces are the cost principles in FAR subpart 31.2. Among other items, this subpart defines total cost as the sum of allowable direct and indirect costs properly allocated to the contract. Well, there's that word allowable again, which has now been used in 3 consecutive definitions. So even a person completely unfamiliar with government regulation should realize you need to know what the term allowable means before you start sending invoices in on a cost reimbursement contract. But FAR 31.2 introduces 3 new terms: direct cost, indirect cost, and allocated. So now that we have looked at some of the more general terms and identified a series of key terms, let's start drilling down, and we'll try to understand what these general definitions mean in the context of defining a cost that can be reimbursed on cost reimbursement contracts. You flip the slide, please. Okay, so the first thing we need to figure out in this definition is, are the costs allocable? And costs are allocable as direct costs if they incurred specifically for performing that contract. They are allocable as indirect cost if the cost benefits numerous contracts or is necessary for the overall operation of the business. An example of a direct cost would be the salary or wages you're paying an employee who's working on the contract. The cost of items purchased from vendors or subcontractors you're using on the contract are other examples of allocable direct cost. Indirect costs are allocable to an overhead account if they benefit numerous contracts, or typically to a G&A account if they are necessary for the general operation of the business, but not necessarily to perform the contracts you have. Facilities and fringe benefits are frequently allocated through an overhead rate, as they would benefit all the contracts and can be more correctly allocated to those contracts or more accurately allocated to those contracts, rather than parsing out your individual fringe benefit costs, by individual contract would likely be a chore and inaccurate. While these expenses, corporate functions, such as your business development, your B&P efforts, your legal department, maybe your finance department, those sorts of things, they're necessary to have for your company to sustain itself and succeed, but they don't necessarily immediately benefit any contract. So they're generally allocated through a G&A. So your first question is, this cost I've incurred, is it allocable? And if so, as a direct or indirect cost. Now, you can incur costs that are just not allocable, and so you would know from the get-go that you can't invoice them. For instance, and I had this experience, your president of the large company thinks he should have a very important artwork hanging in his office for, multiple hundreds of thousands of dollars, which is fine. But the question, is that allocable to government contracts? Well, that piece of art is not helping perform a contract, so it's not direct. It's not really benefiting the performance of any contract, so you can't do it through overhead. And it's not necessary for the sustainment and survival of your company, so it's not really allocable through G&A. So you would know that that's not allocable cost, right from the get-go here. A new slide, please. However, merely determining that the cost is allocable is just the first step, because not all allocable costs are allowable. Once you determine a cost is allocable as either a direct or indirect cost, further analysis is required to determine if that cost is allowable. To be allowable, an allocable cost must be reasonable in nature and amount. By reasonable in nature means, is it the sort of thing a reasonably prudent business person would have purchased to perform their own for-profit work? By amount means, would an ordinarily reasonably prudent business person have paid that much for this item? Please note, these are somewhat subjective standards. So contractors can protect themselves from second-guessing auditors by keeping records that document the reasonableness of their cost. I got 3 bids, took the low one, or I've done price analysis as an example. The expenditure and the manner in which the expenditure is accounted for also needs to be compliant with the cost accounting standards. Obviously, in a webinar of this length, we're not going to discuss cost accounting standards much, and I would say that it's unlikely that the full cast would apply to the attendees on this webinar. However, even smaller companies are going to be subject to the modified CAS in the sense that they need to have consistency in how you account for costs. Like expenses need to be charged in similar ways. You also have to have consistency between how you estimate cost and how you account for cost. So either smaller companies are going to bump into those CAS standards in terms of making sure your costs are allowable. For instance, once you set a precedent by charging a certain type of cost to an indirect account, that cost will henceforth not be an allowable cost on other contracts if you try to charge it to that contract direct, even if other contractors in other situations do treat it as an allowable direct cost. So consistency is going to be a key. The next bullet refers to terms prescribed in the contract, the allowable cost and payment clause being one we've discussed. However, in addition to that clause, contracts, in my experience, frequently contain other limitations. A common theme I've seen is we don't reimburse local mileage. The contractor may reimburse local mileage, but if the contract says the government will not, then that's a term in the contract that makes the local mileage an allowable cost, even though local mileage may be an allowable cost on all of your other contracts. Many contracts say you cannot incur travel expenses or purchase ODCs unless they are pre-approved by the COR. Many contracts require subcontractors to be approved by the contracting officer. So if you incur travel ODCs or subcontract expenses without the requisite approvals, then those costs are also going to be deemed as unallowable per the terms of your contract and will not be something you should be invoicing. Of course, the most famous term of the contract in this area are indirect rate ceilings. When newbies to government contracting without a track record of consistently meeting their projected indirect rates, frequently the contracting officers will require indirect ceilings, and if your actual rates exceed those, well, they're not going to be reimbursed. And lastly, which we mentioned before, costs have to be allowable pursuant to FAR Part 31.2 cost principles. At last count, there were 52 cost principles, though I think one is reserved. The cost principles each address a very specific type of cost and label it clearly allowable, clearly unallowable, or partially allowable, a middle ground where some or all of the costs may or may not be allowable, depending on certain circumstances. The bottom line of this slide is that anybody who is submitting invoices to the government on a cost reimbursement contract should only include allocable, allowable cost in those invoices. And including anything that is not an allocable, allowable cost in that invoice can result in many of the problems we noted in our introductory slide. Next slide, please. All right, Aprio is reasonably proud of this slide. You all just heard a lot of words about what are costs. But for those of you who are more visual learners through graphics, we think this really summarizes it well. As we discussed, your first decision, is it allocable? If yes, as a direct, or is it allocable as indirect? And if you've decided that it meets that criteria, then if it's allocable, is the cost reasonable, compliant with the terms of the contract, compliant with the cost principles, compliance with CAS or modified CAS? And if the answer is yes to all of that, then it's either allowable as your project cost if it's direct, or it's an allowable indirect cost in whichever indirect pool it is. If the answer to any of those questions is no, then it's going to be direct cost, but non-billable. You still have to allocate it to the contract. You're just not allowed to bill it. So it would be a write-off against the profits you're making. And if it's an unallowable indirect account, then you would have to set up an account for your unallowable indirect expenses. All right, so from the contractor's perspective, one of my first managers ever, when I started in this business, as you can tell, a ways back, what he told me is the most important part of the contract to have clear is how and when we get paid. And that's that, to the extent that's good advice, which I believe that it be. So from that manager's perspective, the next part of this presentation that Tram's going to do is going to be the most important part of that webinar, with hopefully now a good understanding of how costs are defined for cost reimbursement contracting. I'm going to turn the floor over to Tram, who's going to discuss the process for actually getting those costs reimbursed.
Thank you, Tom. Before I start, we do have a poll question for you guys, if Aaron can put that up. Just trying to find out how many of you guys here are actually have cost reimbursement to invoice yet. And if you haven't, this will be a helpful, some tips and tricks on how to get paid. That's the important part, right, Tom?
Absolutely.
Thank you, Aaron. Okay, so majority of you don't currently have any cost reimbursement to invoice yet or have that contract, but hopefully that will be in your pipeline and you will win that next in your proposal. And those that have currently invoicing, hopefully these will be helpful tips for you as well. Thank you. Aaron, you can go to the next slide. Thank you. So what actually gives the contractor the ability to invoice government? You might be asking. Again, this fantastic clause that we keep repeating throughout my session with Donna, and here again is the FAR 52.216-7, which is the allowable cost and payment clause. This FAR, if you have this FAR clause in your contract, this will allow you as contractor to invoice government not more than once every 2 weeks. So that means you could bill every 2 weeks if you have a cost system that can accommodate those. Go ahead and go to the next slide. This slide is very good summary to show you the steps of the best practice that should set you up nicely to invoice your newly awarded cost reimbursement contract. So the first step definitely is having that contract fully executed. And the next step, if you have a contracting department, or if you have a project specialist or anyone, or you yourself, the first habit to get into is preparing a contract brief. That's what that is basically a nice picture of the contract, the total funding value, the peer performance, what cleanse, is it a travel cleanse, a labor cleanse, how many cleanses is in that contract? Is there any not to exceed ceiling value of the contract? Sometimes they issue a travel cleanse and say you cannot exceed more than 15,000. Or what other important contract clauses are in your contract? Is there any overtime restriction, any travel cost restriction, or an indirect rate ceiling that might be in your contracts? So the contract brief is just basically a piece of picture of all these important piece in your contract that you have to remember while you go billing every month or go and evaluate your contract every month. And those that have the DoD contract, that have the cost reimbursement contract, you are required to provide your incurred cost submission every year, right? And part of that submission, it's also providing that contract brief. How many active contracts do you have on file? And if you want to see what this document looks like, you can actually go and get it from the DCA website. Within their incur cost model, they do have a template that's called Supplement Schedule O, and that's the contract brief that I recommend you out there if you haven't seen it, or if you want to get into a habit, even if you don't have any cost reimbursement contract, get into a habit of creating a contract brief for any fully awarded, newly awarded contract for you. And then the next thing is start preparing a billing file. Either you put on SharePoint or any type of shared drive that you have for your finance team. Is getting the billing instruction out of your contract is usually on section G in your contract, and that will be having the information that the contract brief has as well. Your contract ceiling, the funded amount by CLIN, the contract peer performance, anything that you can. This will kind of get your billing department or your finance department to be aware of what not to bill outside of your peer performance. Don't bill over funded value. And you also want to prepare a list of your billing acronyms. What that is if you have a CLIN, even with a fixed price, when you submit it into Wire workflow at the end of the month, you have to provide the acronym. That's basically where the funding is kept. So for example, CLIN 1 for labor is an acronym AA. Those are important to track because your funding value is determined by the acronym. So I suggest if you don't have a system to track the acronym or the funding value, it's good to have an Excel spreadsheet as well. That's a good way to start. And also get your point of contacts in the contract as well. In that billing section, it will tell you your contract manager, your anybody that you need to submit a copies of the invoice to every month as well, and the location of where the invoice need to be sent. Some might say wire workflow, some you do have to invoice manually through an email. I want to say majority of the cost plus now is on wire workflow because it has to flow through DCA for review as well. And if you have an accounting system that you can track your project by, this is the time to start doing it after you set up all your contract file, your billing file. The next step is creating this contract in your accounting system so your team can start charging costs too. And then you can set up a process on how that project is set up, who gets to review it first, who approve it first, and is your system capable of putting the funding value in the system as well when you set up this contract, and how many project you need. Do you need a separate project to track travel separate, ODC separate, labor separate? That's usually how your contract is funded. Thank you. Next slide, please. Okay, now you have the best practice in place. We now really need to understand how direct costs are reimbursed. Under this wonderful FAR clauses again, it's going to become my favorite clause or yours because I'm going to keep repeating it. We now need to understand the process and the timing of how incurring a direct cost and how this cost is later invoiced to the government. As noted on this slide right here, costs are identified as those recorded costs that as of the invoice submission and the contract has paid, or in the word incur. Hence the term, the pay to cost rule that some of you might be familiar with. This means that you incur a cost, pay for it and recorded that cost, and you deem to be reasonable, allowable, applicable in your accounting system. After all this is taken in place related to a direct cost, well, that's when we have to invoice those costs. So you could then be reimbursed for those costs. That's where we get that term cost reimbursement contract from. So as you can see on the bottom of the slide right here, I have included an invoice tip here that said it is always best to generate an invoice in the system rather than externally creating an invoice and record it into the system. I will tell you why next. Go ahead to the next slide, please. Thank you. Why talking about cost reimbursement, there's always exception when we talk about government compliance here. These exceptions are costs that often recorded but not paid for. For example, your payroll. This is okay to include in your invoice as long as your payroll is in accordance with your company's payroll policy. Another one is travel. As long as your employees are being reimbursed in accordance with your travel policy, then it's okay to include this cost in your invoice. Then the next is your indirect rates. You are invoicing at your provisional billing rate with the understanding that you will true it up these rate at the end of the year. Remember that provisional billing rates that Donna and I mentioned in our first session? This is where it's in play right now. Billing at your provisional rates help you stabilize your indirect rates that your contracting officer see in each invoice. And if you remember, we suggest that the provisional billing rate gets submitted to your contracting officer at the beginning of the year, of the billing period, so they can agree with it, so you can use the same rate to bill every single invoice, unless we go into, monitoring your rates monthly, and you see that your costs have increased so much that you have to now contact the contracting officer to go and have to revise your rates during the year. The last exception on here is your subcontractor and vendor. You can include these costs in your invoice as long as you pay that subcontractor or vendor within the terms of the subcontract, usually ordinary within 30 days of submission of the prime contract invoice for the costs incurred. So that's a really important part for a cost reimbursement contract. And I can tell you that when a pre-award accounting system audit is performed prior to them awarding you the cost reimbursed contract, they actually look into this to make sure that you pay your subcontractor, you pay your vendor according to with these rules. Next slide, please. All right, now what's after direct is the indirect costs. Here's the here's the FAR clause again, the allowable cost and payment clause. Here's the statement in there. It's basically state that your indirect cost, direct rates shall be reimbursed at the billing rates established by the contracting officer, subject to adjustment when the final rates are established. If you hear at the first session with me and Donna, this is what we were talking about. Again, the budgeting rates for billing purpose at the beginning of the year. Let me also mention here that the billing rates are sometimes called provisional billing rates, NICRA rates, or budgeted rates. Those provisional bill rates are the rates that consistently apply throughout the year to your costs, and these are the rates that you should be used for your ongoing proposal, unless all those special scenarios that we went over in session 1. You also want to make sure that they are applied to all your invoices. If you take a look at your actual costs during the month and there's a huge significant difference, like we said, monitoring your actual costs every month, then you want to have a decision and see how you want to handle your over and under run at this time. If your rate come out materially different, then I suggest contacting the contracting officer right away, have some kind of mutual agreement, so then you can get your billing rates adjust mid-year, quarterly, so then you don't have to run through the end of the year and see, oh my God, there's a huge gap between my billing rates and my actual rates. And now you either owe the government back or have this huge overrun that you have to bill them now. And they're might not be happy about that. So going back to what Tom has said earlier, have that relationship with your contracting officer. So then you can go, talk to them when things like this arise. Next, please. Sorry if I go too fast through this, but to summary what I have mentioned, here's a layout of all the action that you need to consider as a contractor. First, prepare that annual budget in a timely manner. Hopefully, if you were at the first training session, you have heard what we said, or go back and watch that recording session now. And then with that annual budget prepared, now you can use it for your billing rates for the year. Submit it to your contracting officer, copy DCAA for approval. Sometime they look at it, and if your rate hasn't changed since last year or within reasonable, you usually just get an email from them say, yep, go ahead and bill with that. There's might not be any official letter saying that they approve your provisional billing rate. And you can take that email as a, hey, okay, go ahead and bill this at the beginning of the period. But sometimes they come back. If there is some differences between your rates between prior year to this year, they might ask additional question. Hey, why is your G&A gone up? Why do you have a new rates this year? Why do you have a material handling this year versus last year? So there might be some negotiation or some communication that you just have to provide more additional information before they can accept your rate and approve it. And once they accept it, you can start invoicing your new year with new rates. Okay. Next, please. All right. Now the next one is the important one, I think. So now that we understand how to get reimbursed for our direct and indirect costs, how do we true up your indirect costs? So I'll go in a little bit more detail on what session 1 has gone through. Is that at the end of the year, you need to get your actual cost, calculate your actual rate. So now you need to submit your final indirect rate proposal, as we discussed earlier, and that is called an incur cost submission. This needs to be submitted to your contracting officer and audit agency within 6 months of your end of your period. So for example, your year end is December 31st, your incur cost submission is due June 30th of the following year. Typically, your incur cost submission, short for ICS, is then audited, or if there's low risk, we have more information on that. If you need some help on high risk, low risk, and how they determine what's considered low risk and high risk. But sometimes you just get an email and say, hey, or a letter, we agree with these rates. These are your final rates. So there's no audit. They don't need to review anything. They agree with your actual rates, and you can take that and do a true up invoice. Either is it low overbill or underbill. But sometimes if you consider high risk, for a certain reason that we can go into detail in the Q&A, is that you can get selected for audit. And that means that they're going to go in there and look at your actual cost and actual rate and see if it's reasonable and allowable. Especially if your rates are much higher than what you were billing. So they want to see, why is there a gap there? And so I recommend at the end of the year, you do prepare your ending invoice with your actual rate to flush out any, variances between your provisional billing rate versus your actual. This will decrease your amount of over and under billing when you prepare at the contract closeout. And that's another topic that we can help out with. So when you prepare your true up invoice, you can either submit that to the government that they owe you money, or you have to write them a check back if your actual rates is lower than your billing rates. Hence why that session 1, we kept saying, monitoring your rate, keep looking at your rate yearly or even quarterly or monthly. That is where it's in place important right now. So you don't want to have that huge gap and a surprise at the end of the year when you actually look at all 12 years of costs. 12 months of costs. Okay, next, please. Okay, now I'm going to hand it over to Tom here. I know I talk a lot about how those costs are being reimbursed, but how do you have a good system to keep those costs so then you can be aware of all these tracking, monitoring, all these stuff that we talked about? So I'll hand it back to Tom so he can talk more about the accounting system requirements that can allow you to do that.
All right, thank you very much, Tram. And now that we've defined the term cost and described the process for getting your cost reimbursed, I'm going to conclude the webinar by providing some practical tips for managing cost reimbursement contracts. And I'm starting with a big and perhaps obvious one. In order to successfully manage the cost reimbursement contract, you need an adequate accounting system. The government's so convinced of that, the FAR requires that the contract officer determine that a contractor has an adequate accounting system before a cost reimbursement contract can be awarded. As the old saying goes, you cannot manage what you cannot measure. And I would add that you can't manage what you can't forecast, and you need an adequate accounting system to do either of those. Now, the attributes of an adequate accounting system could be a whole webinar on its own, so we're just going to hit the high points here. In general, you need an accounting system that can account for direct costs at the project level. And those direct costs might need to be allocated to the project level by CLIN, by sub-CLIN, by ACRN, by third level work breakdown structure, et cetera. So you may have some fairly granular direct cost allocations that your accounting system needs to support. And the accounting system needs to be able to calculate and apply indirect rates to intermediate and or final cost objectives. Please note that not every off-the-shelf accounting system can do this, or at least can do it easily. So you need to review the capabilities of your accounting system if you're planning on bidding cost reimbursement work. Next slide, please. Thank you. Those of you familiar with cost reimbursement contracting will recognize the reference to the standard form 1408. That's the accounting system review checklist used by the DCAA. I'll just highlight a couple of points. An adequate accounting system for cost reimbursement work will be GAAP compliant. We'll be able to segregate direct costs from indirect costs. We'll be able to allocate indirect cost, intermediate, and final cost objectives. We'll include a timekeeping and labor distribution system, and will ensure that unallowable costs are excluded from any contract billing. Last but not least, even if you have an accounting system that accomplishes the first 5 bullets, if you do not have written policies and procedures describing your accounting system, then it will not be deemed an adequate accounting system. Next slide, please. On this slide, we provide guidance for managing direct costs. On the manage what you can control theory, the project manager should be responsible for managing direct costs. The first action is to develop a project budget by cost element, by time period, with possible further subdivisions into CLINs, WBS elements, etc. Budgeting by cost element is essential because it's important to be able to attribute any deviations from the budget to the specific cost elements involved, i.e., was it direct labor, was the escalation bid wrong, etc. The budget could be right out of the proposal, or the budget might need to be developed independently as part of the kickoff of the project. Also, a good project budget should include a management reserve. The management reserve may protect a little if there are increases in direct costs, but frankly, the management reserve is typically established as a safety net should there be indirect rate overruns, something the project manager has little or no control over. Once you develop the budget, you need to monitor the actuals by cost element against that budget on a monthly basis to determine whether you're on, over, or under budget, and both at the bottom line and by cost element. The reasons for any deviations need to be explained and ramifications on contract performance understood. The point I want to make here, though, is that you need to manage this on an accrual basis. The costs associated with a commitment you've made to buy something from a third party typically do not hit the books until an invoice is received, or perhaps until the invoice is paid, which can be months after that commitment was made. The project manager has to view those funds as expended at the time the commitment is made, not months later when the invoice is paid. That's what we mean by managing on an accrual basis. The point is that a monthly cost report from the accounting system may not provide the project manager with all the information needed to manage the contract. Therefore, Aprio highly recommends that you utilize a program control function if you are performing cost reimbursement contracts. For those unfamiliar with that function, program control is an interface between the accounting department and their needs and the project team and their needs. Because the accounting department is really trying to do GAAP-compliant accounting to produce auditable, reviewable financial statements as may be required by their stakeholders, trying to run accounts payable and payroll departments, and trying to prepare invoices in accordance with very complicated regulations. Typically low on the list of priorities is providing project management level cost data to the project manager. That's not something that just flips right out of the typical accounting system. The program control person takes the responsibility of setting up the project's charge number system in accordance with the contract's reporting and invoicing requirements, as well as the internal program management needs. and the capabilities of the accounting system. They also interpret the accounting data that comes back from the systems and may have to slice and dice it into the granular information needed for the reporting, invoicing, or general project management. Program control position can also keep track of accrued expenditures that haven't yet hit the book, so you can manage by accruals. Okay, larger companies have entire departments of program control. Smaller companies might be a one-person operation or even a duties is assigned to somebody else. But we strongly recommend a program control function be utilized when managing a cost reimbursement contract. Next slide. On this slide, we address managing cost reimbursement contracts from the perspective of managing the indirect cost. And again, we'll start with responsibility. Managing indirect costs and ultimately the rates is typically a back office function, but whose? We sometimes ask clients who is responsible in your company for managing your indirect cost, and we frequently get an answer like, I don't know what you mean, or simply, I don't know. Well, some belly button, as I like to say, needs to be responsible in your company for managing your indirect cost. And how do they do that? Indirect costs should be managed on a monthly basis by comparing the actual indirect cost and allocation basis to the budgeted amounts. If the indirect cost and allocation basis are tracking to the budget, such that your provisional billing rates, which Tram mentioned, are still accurate, you don't have to do anything. However, in most instances, that does not happen, which means you have to manage your indirect cost and rates. If you're experiencing an underrun, if your actual rates are underrunning your provisional billing rates, you have a couple of choices. One of which is, as Tram is that you may be the perfect time in your life cycle of your company to make some indirect G&A type investments of added infrastructure or G&A type people, add a business development person or a contracts manager, or invest in some sort of business software. Conversely, it might be beneficial to allow the rate to continue to underrun because if you have a lot of fixed price or fixed labor rate type work, that would increase the profit on those jobs. And even on the cost reimbursement work, you would have more of the estimated costs going to direct labor and less to indirect rates. So the person, conversely, however, underrunning your indirect rates is less likely than overrunning them. And if you're overrunning your indirect rates, you should take action immediately to try to reduce the indirect costs you're incurring such that you do not ultimately overrun your rates. And you can't really just say, well, let's hurry up and win more business to increase the base. So you pretty much have to focus on reducing the cost. So the person managing their costs needs to reduce it. And I want to use an example of a company I used to work for that will remain nameless. At the start of the fourth quarter of our fiscal year, we would all start getting cost-cutting memos and emails. All open and direct positions are frozen. No new hires will be added until the start of the next fiscal year. No indirect personnel will be allowed to attend training. No indirect personnel will be allowed to travel. Nothing can be purchased that's going to be charged in accounts, etc. You can just set your clock by getting all those memos at the start of the fourth quarter. So if you're unable to reduce costs enough to bring them at or under the budget, you end up with an overrun, then you're going to experience less profit on your fixed price and fixed labor work, and you will get less work done on your cost reimbursement work. And if you have indirect rate ceilings, you may actually experience loss on that cost reimbursement work. Okay, once you've reached the point where you can safely say we will materially over or underrun our indirect rates, then you should request adjustment to the provisional billing rates through your contracting officer. Failure to request an adjustment, continue to bill at your inaccurate rates creates problems. If your actual rates exceed the provisional billing rates, you've got a cash flow issue. If you're underrunning your provisional rates, then you've got an issue where you're billing at higher rates than you know you're going to collect, which is a potential false claims problem. Now, that all said, sometimes, maybe many times, a contractor requests an upward adjustment to the provisional billing rates, and the contracting officer refuses to change them. In my experience, they're more willing to change them if they go down. The contracting officer typically says, hey, I had these rates audited at the proposal stage. We incorporated the contract. I'm not going to turn on a new audit. I'm not going to sign my name to any unaudited rates. Just continue to bill to provisionals, and we'll true it up at the end during the process Tram described. Of course, the we, who will true it up at the end, years later, does not usually include this particular contracting officer. Next slide, please. Project managers do not usually manage indirect rates, but they need to react to them. The point on this slide is that you need to manage your cost reimbursement contracts to the actual indirect rates your company expects to incur, not to the provisional rates that are used in invoices. This is true even if the contract officer has refused to change the provisional billing rates. Provisional billing rates affect the timing of when your indirect costs are reimbursed. Actual indirect rates should be used to manage the contract. Next slide, please. I think we need a next slide now. Okay, this slide addresses one of my pet peeves, which is using invoices as a project management tool. As Tram pointed out, invoices are at provisional rates with little or no accruals. The cost reimbursement contract needs to be managed on an accrual basis with actual indirect rates. The invoice, and I cannot stress this enough, invoices are a tool for collecting cash in a highly regulated environment. Invoices are not a good project management tool. Next slide. Now we will discuss two extremely important clauses which fall under the heading prescribed by the terms of the contract. That would be the limitation of funds clause and the limitation of cost clause. They are very similar. Limitation of funds clause is used when the contractor is incrementally funded and ties the government's obligation to reimburse the contractor to the funded amount. The limitation of cost clause is used when the contract is fully funded, and then it ties the government's obligation to reimburse the contractor to the value or to the estimated cost, if you will, of the contract. Both clauses require pretty much the same thing. The contractor agrees to perform up to the point which the total amount due the contractor approximate does not exceed the contract funding. There is a myth that the government is contractually obligated to reimburse all of your expenditures on a cost reimbursement contract, or at least all up to the contract value. But that is a myth because these clauses make clear the government's obligation is to reimburse contractor is limited to the funding on the contract. And the contractor's job is to perform the contract without exceeding the funding. You can stop work when the funding is fully expended, but you can't continue to work and spend money you don't have, as if the contract was a blank check. In order to help ensure that the contractor does not spend more than the funded amount, these clauses require the contractor to notify the contract officer in writing whenever the cost you expect to incur within the next 60 days, when added to the cost already incurred, will exceed 75% of the funded amount. The government does not like the, oh, by the way, we're out of funding surprise. This notification requirement gives the government at least several months of advance warning in the event more funding is needed. One last point, many people view this as a 75% notification. When I get to that point, I notify you. However, you have to let them know 60 days in advance of when you expect to hit 75%. Hence, back to my comment that you have to forecast your costs to successfully manage cost-type contracts. Incidentally, I've worked on contracts with such little incremental funding that we had to submit the limitation of funds notice the day we got the contract, kind of thing. Next slide, please. There's an oft-neglected second requirement of the notification beyond just the date you would hit the 75% expenditure mark. The notice must include the amount of additional funds required in order to continue performance through the contract period. This is simple if no additional funds will be required. You can just state that the existing funds on the contract are sufficient for us to finish performance. Thank you very much. Conversely, if the contract does not have enough funding to finish performance, you have to tell the contract officer in the notice what day the current funding will be fully expended and how much additional funding will be required. Costs in excess of the funded amount will not be reimbursed unless they've received this accurate notice and added the funding. As we have hopefully made clear, the funding requirement calculation must include accrued expenses and be based on actual, not provisional indirect rates. Walking your contract funding down to zero based on artificially low provisional billing rates and ignoring your accrued expenses on the theory the government will find the funds to pay me later when the rates are trued up is a very bad idea. A contractor needs to leave enough funding on a contract to pay for their actual cost, even if such payment will not happen until the rates are trued up at the time the contract is closed out. Sometimes the COR, and I've even had contracting officers say, I don't understand how you think you're running out of money. I'm looking at the cumulative date on the last invoice, and it seems to me there's sufficient funding left. So you frequently have to explain the invoice uses provisional liquor rates. Contracting officer will not let me update the invoice to the actual rates. I have to manage the contract based on the actual rates, and I have to leave funding in the contract to pay for the actual liquor rates that I know I'm incurring. That's something that's sometimes hard to explain to the government officials, but it's what you have to do. Next slide, please. So in conclusion, I'll try to sort of quickly summarize what we've discussed. We provided a short introduction to cost reimbursement contracts, whether some of you needed it or not. Then we explained how costs are defined on cost type contracts. They have to be allocable as either direct or indirect cost and be allowable. We described the process for preparing cost type invoices, including the requirement to comply with the paid for cost rule for direct cost and establishing provisional billing rates for indirect cost. We also described the process for truing up the provisional indirect rates. We provided several practical tips for maintaining an adequate accounting system and establishing contract direct budgets and company-wide indirect budgets and managing them on a monthly basis. We emphasized the importance of managing the contract on an accrual basis with actual indirect rates. Please do not try to manage your cost reimbursement contracts using the invoice. Lastly, we discussed the importance of the limitation of funds and cost clause notifications. Submitting a cost type invoice is a highly regulated activity, which subjects you to all sorts of risk, including Civil False Claims Act violations, and, as I said, in criminal cases, possible criminal violations. A contractor should not be submitting a cost type invoice unless there is somebody in that company that understands the definition of cost, including the FAR cost principles, and can certify that only costs you are legally entitled to have reimbursed are included in that invoice. If you do not have people in your company that understand the requirements and then can so certify, you should be very wary about submitting cost type invoices. That all said, the guidance Aprio provided today, along with the application of our practical tips, should help ensure that your experience with cost reimbursement contracting will be both pleasant and profitable. So thank you very much. And I believe we have some time for questions.
Yes, we do. Thank you, Tom and Tram, for excellent presentation. Lots of very useful and great information. We do have some time for questions. I know there's been a number of them that have come in throughout the presentations. But if there's additional questions, please submit them in the Q&A box, and we can go from there. We can either do them live or I think that would probably be best if you put any questions that you have, and I can ask Tram or Tom to answer them directly.
I have one that's good right now. I can read off so Tom can help me answer. I can answer and Tom can add to my answer. Is that the question from Stephanie? She basically said, if you submit a limited fund notification, can the government cancel the contract from your company and give it to someone else? Well, number one is if you have that funding limitation clause in your contract, you have to notify them. There's no out of that. So you have to notify them either if you reach 75% or 80% of your cumulative costs that you have incurred. This comes down to the relationship that we were talking about, building that with your contracting officer and the quality of your deliverables, right? What has it been good? The project's been in the good terms. Then sometimes the contracting officer just like having that clause in there so then they can have time to go get more funding to fund the contract to keep it going. So they actually appreciate that notification, not necessarily that hey, we're running out of money, let's jump to the ship. So I don't think it's negative for them to have that clause in there. It's actually just give them more time to get funding. So here we go. Have a good relationship with your contracting officer. And I think Tom wants to add to this as well.
Yeah, I'll just add, I've never heard that happen. On a routine notice where the contract is incrementally funded, they're fully well aware they need to get more funding. If you wrote a notice and said, hey, I know we agreed to a $10 million value 3 months ago, but I'm sending you a notice now telling you I'm going to need $50 million to finish. If that's what your notice said, then I'm assuming that terminate the contract. rather than proceed. But I wouldn't have any worry about submitting the normal limitation of funds notice. I've never seen that happen.
Yeah. Here's a good one too, Tom. How do you work as a subcontractor when the prime contract wants to do a CPFF subcontract to you? And do they adjust rates and true up at the end of the same way when it's directly with the contracting officer? You want to answer that?
Yes, I've experienced that many times in industry. That's a good question, and it's a bit of a tough road to hoe. The way the FAR reads, if the prime contractor chooses to award a cost reimbursement subcontract, then the subcontractor would be disclosing all of their proprietary, typically cost and pricing data and whatnot to someone who might be a competitor of theirs, on the next bid. So typically in that situation, you end up with a complicated process that involves the contracting officer either willing or unwillingly, in that you would submit a what we would call sanitized invoice to your prime, as opposed to the invoice that really builds up all your cost and pricing data to show, the buildup in invoice, with a theory that the backup for the invoice would be submitted, directly through the government. And the same thing with your incurred cost submissions and whatnot. You would want to have the deal that your incurred cost submission goes directly to the government. And then you get in goofy situations as the prime contractor, where a contracting officer is calling me and saying, hey, we looked at the audit or whatever, and I can't tell you any details, but all I can tell you is we think their G&A rate's about 1% too high. And then as the prime, I'm going like, I don't really know why, but I'm pretty sure your G&A rate's 1% too high, so we got to get that sorted out. So that's a very good question. Where I had worked before, I alluded to that one at the time, where I had worked before, we couldn't issue cost reimbursement subcontracts without the permission of the vice president of something or other, because it's just such a huge hassle to do for all parties concerned. And then forget closeout, because you have a prime contract and you can't close that prime contract out till your subcontracts are closed out. And if you have a bunch of fixed price or T&M subcontractors, they're pretty simple to close out. If you've got a cost reimbursement sub, they may not be able to get theirs closed out, which is holding you up from getting yours closed out. So the only time I was ever allowed to award cost reimbursement subs is if we had a cost plus award fee or a type of contract where it wouldn't make any sense to say the award fee only applies to a little bit of the work we're doing. The bulk of the work done by all these, the work fee doesn't apply to them. That wouldn't have been good selling. But other than that, they didn't want us to issue cost reimbursement subcontracts. It was just too complicated.
Thank you, Tom. That was good. We have a really good one now too. I can answer this and you can add. It's basically asking, what is your advice for a small startup company to come up with an approved or compliant accounting system without a significant investment in Deltek or other system? When it comes to compliance accounting system, right? I think what you need to look at is, when they say system, not necessarily mean an actual, Deltek Uninet. That means your process. So there's 18 criteria that Tom had hit a little bit in this session about what you need to be compliant. It's basically, you can have QuickBooks, you can have other accounting system, but you just have to align your system with these criteria. Basically, how do you record your costs? Is it recorded by project? Is it recorded timesheet? Do you have your employee doing timekeeping? What type of timekeeping system are you using? How they just want to reassure that when you collect the costs, it's accounted for direct, indirect, and they are billed correctly. How do they assure that you have internal controls that the costs you bill are allowable, applicable, and applicable to the contracts? So there's 18 criteria for the accounting system that you can look at and determine if the current system you have right now, it's up to it, or what kind of process you need to change, what other manual step you need to add to be compliant with it. And I will put that criteria in here for you in the Q&A, so you can take a look. And if you have any question, reach out to me or Tom or anybody at Aprio. We can help you with that as well. Anything you want to add to that, Tom?
Yeah, at the risk of being repetitive or mentioning brand names, it's not necessary to have an adequate accounting system that you have a big sophisticated Deltek or Uninet, software investment. People run adequate accounting systems using QuickBooks all the time. You have to augment QuickBooks with some stuff a little bit outside of QuickBooks to combine it to work. But you do not need the huge investment of the big software systems that the larger companies would want. You can get started in cost reimbursement with a relatively modest investment, in my opinion.
Thank you. We have a follow-up question. Will you consider QuickBooks acceptable here as long as the points that both of us have brought up to the 18 criteria? Yes, we have helped clients, contractor pass DCA audit on accounting system with QuickBooks. Like Tom have added that there might be some extra process, internal controls, some manual stuff that you need to do to be in compliance with it. Hopefully that answered your question. I will also paste a link here for you for some helpful tips on that too. And again, reach out to myself or Tom, and we can help you get into the detail of identifying the gaps that you currently have in your system as well. So then you can start putting everything in place to be compliant.